The macroeconomic Super Bowl is here and markets are making major moves. Jerome Powell's speech in Jackson Hole just wrapped up and there's no shortage of serious drama already. So the S&P 500, we can see when the speech was released here at 7 a.m. Pacific. S&P and risk, broadly speaking, rallied quite hard. The NASDAQ is up about 1.8%. We can see SPY, the S&P 500, is near the high of day, just kind of hanging out, grinding higher. Volatility cratering as a lot of the hedges that had been put on over the past week got unwound. You see volatility back to a 14 handle. If you look at yields at the bond market across the curve, yields are down, bonds are rallying. The 2 years seeing the biggest move, down about 10 basis points. Here is when non-farm payrolls came out, by the way, just for comparison. The belly of the curve is down about 8 basis points. The long end is down about 7 basis points. Bitcoin's up 3.9%. Gold is up 1.2%. And if we look at the dollar, a 1% move down in the dollar. So more dollar weakness with lower rates and with this more dovish, slightly mildly dovish speech. I made some notes. We'll go through those. The euro's making a big move against the dollar, up 1% versus the dollar. And the dollar yen is down 1%. So yen strength. Some major moves there. Remember, DXY is mainly the euro, about 45%. So here is the first comment, and this will sound familiar for anyone that's been paying attention to the Fed. He made a mention that the economic conditions that they face currently put their policy goals in tension. Their two goals are stable employment, so low unemployment rate, and low inflation rate. He noted again, as he always kind of does over the past year or so, certainly a quarter or two, he has been noting this, that the policy goals are in tension, meaning inflation is moving higher. There's upside pressure to inflation. Okay, that's going the wrong direction for them. But there's also upside pressure with the unemployment rate, which again is also in conflict. So they only have two tools, balance sheet and interest rate, the overnight interest rate. They control that overnight rate. That is the federal funds rate. Those are their two tools. So if you have higher unemployment, their logical move is to cut that overnight interest rate, reduce rates. Well, if you have inflation moving up, that's going to push inflation even higher. So hopefully that concept makes sense. Their policy goals are in tension with each other. He also, the markets love this. There was a lot of pricing out over the past week in terms of a September cut. We did get an indication that we will get that September cut. He said, prepared to adjust our policy stance if the economic data supports such a move. Now, the labor market. So here we're looking at initial claims in the 12-week moving average. And we covered this yesterday when this data was released. Here is continuing claims, unemployment rate, and the 12-week moving average for claims. We can see that they have all been moving higher going back to October of 2022. So again, he made a mention of the labor market cooling and this being a upside pressure to the unemployment rate, downside pressure to the labor market. We got that very, very weak non-farm payroll print that made Trump decided to fire the BLS commissioner over. And so this kind of spooked the Fed from my read on the speech. He made a number of comments about the labor market and significant risks in the labor market. Now, the important thing is he mentioned the immigration policy. So we've been kind of banging this drum for many months now that during kind of the prior administration, what they did to help disinflation, to help keep inflation low, remember, a huge portion of inflation is wage growth. And so what they did, whether intentionally or not, at least from an economic standpoint, it's just objectively what happened, they dramatically increased the labor supply. Well, that kept wages and therefore inflation, wage growth, low because they dramatically increased the labor supply. Well, this administration is going the opposite direction, which is to reduce that labor supply. So mechanically, wages will go up, law of supply and demand, supply-demand curve. So as they reduce the labor supply with the immigration policy, you will mechanically get higher wages for those that are still here and employed here in America. So this is a pressure to inflation. Remember, the Fed and economists, broadly speaking, see wage growth as a problem uh, because it is a driver of inflation. So they generally speak about wage growth as a negative thing. So it's important to keep that context. The other thing I want to make a mention of is despite the fact that, over the past 2 or 3 years, continuing claims and the unemployment rate are going straight up, if we look on a long-term time frame, here is the unemployment rate, 4.2%. We can see it's near historical lows. So, despite the fact that it's been climbing over the past 2 or 3 years, it is still, when you zoom out, quite low. And continuing claims as well, 1.95, 1.96 million. This is even lower than the unemployment rate would suggest. Now, of course, there is issues in certain areas, certain industries have a cooler labor market than others. We can see the Beltway, kind of the old bureaucracy and Doge and the effect that that is having on the Beltway area. And of course, also the youth. So here is the U6 unemployment rate for 16 to 24. We can see is at 16%, 17%. This is actually quite high. We also know that new college graduates have a similar unemployment rate to those that did not go to college. So we are seeing some major softening in the labor market, but to some degree, some of it is just kind of normalization after the past 5 years, where the labor supply was dramatically increased and now is kind of starting to normalize. So some degree of normalization is to be expected. But what they sound worried about is it kind of getting ahead of them and getting away from them. Remember, this stable employment or low unemployment is one of their goals. They say that despite some stability, unemployment picture shows early indications of potential strain. So they again see upside risks to inflation. This is not good. If you're the Fed, upside risk to inflation is not good. And it's even worse because you can't expand your balance sheet and cut interest rates, which is the usual kind of response to that higher unemployment rate. You can't do that if inflation is higher. So he again noted risks with inflation. I'll go through a couple of those comments. He said, while inflation has eased, yes, headline CPI was 9% and is down to 2.7%. While inflation has eased, the effects of recent tariffs are becoming visible in consumer prices, posing ongoing challenges. Tariff-related pressures on inflation remain a significant factor in our deliberations. Now, I would just ask for anyone to show where these where this tariff inflation is, because if you look at PPI, services, which is the salmon color, makes up the vast majority. Goods, less food and energy, is dark blue, and it's like 20 basis points of PPI. If you look at CPI, it's the same story. Here's core CPI, services in light blue, and goods in this kind of golden color. And again, it's only like 20 basis points on the year over year number in terms of goods inflation. So yeah, could tariffs cause 10, 20, 30 basis points of goods inflation? Sure. But, in terms of kind of this notable spike in inflation that everyone kept telling me was going to happen, has not happened yet. Now, maybe they are seeing advanced data. Maybe there is secret data that I don't have access to, but these all show that services is mainly where the inflation is coming from. Goods inflation remains very, very tame in comparison. Now, maybe they are just worried that in the future goods inflation will pick up. But he made a couple comments about tariffs. He said the introduction of new tariffs has added a layer of complexity to our inflation outlook that we are actively monitoring. They are contributing to price pressures that we could not ignore in our policy framework. There was some discussion about one-time increase versus kind of a cumulative thing, right? Because really, at the end of the day, a tariff is a tax. Taxes are not inherently inflationary. Inflation refers to an expansion of the money supply, rising prices just being a consequence of monetary inflation. That's maybe a topic for a different story, a different video, but he mentioned kind of two outcomes with inflation. So we can see headline inflation's at 2.7. Core inflation, removing food and energy, which are very volatile, is running above 3%. It's at 3.1%. He also made a comment of inflation expectations, saying that they remain well anchored. Well, not from the University of Michigan data. This is very worrying. This should be very worrying for them. Now, these expectations have come in from 6.5% down to 5%, but they are still notably above even core CPI, which is running higher, they are still notably above. There's a wide delta between the two. So seems to think inflation expectations are well anchored, and so not super concerning. But if you look at you, Mitch, they don't look super well anchored. But he mentioned two outcomes. So I'd mentioned kind of a one-time price increase versus a cumulative thing. So theoretically, it should be, and some are saying that a tariff will just be a one-time increase. You institute the tariff, and that month or the next month or whenever the tariff takes effect, you do get a slight increase in the cost of a given good, but it's just that one time, right? Because then the price it doesn't go up. There's not a new tariff every month. The tariff rate is what it is. If it stays stable, it should be a one-time price increase. Well, that is option A. He also introduced option B, which is more concerning if you're the Fed, which is that consumers, because of higher prices, have decrease in purchasing power. So because of that, they go to their boss and they say, hey, I need higher wages. Again, this is one of the reasons we believe services inflation. We said that services inflation and inflation, broadly speaking, would pick up mainly due to immigration and the purchasing power loss, the destruction in purchasing power that most average Americans saw in the past 5 years. They are kind of already in a hole. Well, what he is saying is not only are they kind of already trying to claw their way out of a hole, demanding higher and higher wages to make up the purchasing power they lost, but they might, if they have decreased, if prices are going up and therefore they have decreased purchasing power, in the future, they could start demanding higher wages, and that could cause what they call the wage price spiral, which is where higher wages and then inflation starts to pick up, demand starts to surge from the higher wages, prices go up, and it becomes kind of the self-fulfilling cycle, and is mainly a question of inflation expectations. What does the populace think about inflation? If the populace thinks that inflation is going to spike, as we could see from UMich, 7%, 6.5% CPI, then the potential for that wage price spiral is higher. And so again, he made a comment that kind of cumulative or wage price spiral sort of option B. He said he doesn't think that's very likely, but he also said that inflation expectations are well anchored. And so if you believe that inflation expectations are not well anchored, as we can see here, then the potential for that wage price spiral, in my opinion, would go up. And so he seemed to think it was not very likely that we see that kind of cumulative wage price spiral and higher inflation, higher wages, higher demand, higher prices. But that's based on an inflation expectation remaining well anchored, which it does not appear to be. So with regard to kind of overall policy, every couple years they revise their general framework. Remember, after 2008, we had very, very low growth. Inflation wasn't even at 2%. For many, many years, the inflation was below the Fed's target. The economy, real GDP, was quite soft. We kind of had our own version of Japan's lost decades, where growth was very poor and potential sub trend following 2008. The Great Moderation. Well, he made comments about needing to revise that. We know interest rates have broken out of a 70-year downtrend and are headed higher. We know that inflation is sticky, and it's sticky up at, say, 3% rather than 1 or 2%. We know services. We've covered that with the immigration piece and the labor story and wages. We've talked about that for many months now. We've also talked about the inflationary impact of deglobalization. This is also another inflationary impact. Well, if you look at the fiscal 7% pro-cyclical deficit, he made no mention of fiscal that I caught, but that is also inflationary. Shifting debt issuance into bills, that is inflationary, especially negative real rates. That is even more inflationary, which is what Trump wants to do. So there are all these upside risks to inflation, and clearly we are in a new regime. We can see whether it's the dollar, whether it's the fact that we're talking about an erosion of Fed independence. I mean, you kind of go down the list. We are clearly in a new regime. And so they have to revise their framework. We are not in the post-2008 regime. What he said is, we're committed to a careful data-dependent approach to achieving our dual mandate. Our policy decisions will reflect a balanced consideration of both inflation and employment goals. He does believe that rates, the policy rate, that overnight interest rate is restrictive. Here in white, we have the 10-year real yield. This is the 10-year yield minus inflation. This is the real yield on the 10-year. Of course, if you look at the 2-year, it's a different story, but here we're looking at the 10-year. And we can see that the real yield above inflation, you are getting 1.56% above the inflation rate. This is called the real yield, or the real rate for the 10-year. You can see it was in this long-term downtrend and is starting to break out, just like yields are as well. This is reflecting concerns over future inflation. Although he notes the federal funds rate, which is here in white, 4.33. So while real yields are restrictive, about 150 basis points above inflation, the federal funds rate is 200 basis points above inflation, almost. So inflation's running at 2.7, their policy rate's at 4.3. What that means, remember, why the term restrictive and why this all matters is that they believe in this kind of ephemeral neutral rate, where there is a neutral interest rate where it is neither stimulative nor restrictive. And no one can really define it. There's all sorts of models and formulas, but no one can really define it. And if they think that policy is restrictive, what that means, the interpretation for you to read into that, is that they have room to cut. So he did say that he believes that they are in restrictive territory, which means they have room for cuts, because they can still cut the federal funds rate and it'll still be higher than the inflation rate. That is what they are referring to with those comments about restrictive policy. He also mentioned the balance sheet. So here we're going to look at the balance sheet. Remember, the Fed prints bank reserves out of thin air. Those are here in blue. Those bank reserves are then transferred to a private bank in exchange for some assets, usually U.S. Treasuries or mortgage-backed securities. And here we can see the value of the balance sheet, $6.6 trillion that the Fed owns on their balance sheet. Bank reserves are currently at 3.3 trillion. What he said is that the balance sheet runoff, the Federal Reserve will slow the pace of balance sheet runoff starting April 1st, reducing the monthly redemption cap on Treasury securities to $5 billion. Slowing quantitative tightening, remember, which is what they have been doing, letting these assets mature. This has a negative impact on bank reserves. Slowing quantitative tightening, or QT, should not be seen as a policy move, but as a technical adjustment to ensure stability. So this reduction in the balance sheet, remember, they have two tools: the balance sheet and interest rate. As they reduce the balance sheet, that is effectively destroying bank reserves. And this has a tightening effect. As we can see, bank reserves were 4.3 trillion. Well, basically $1 trillion of bank reserves were destroyed from taking the balance sheet from 4.2 trillion, or excuse me, 8.9 trillion down to 6.6. That effectively destroyed bank reserves, which are half of the monetary base. The balance sheet as a share of GDP is still an astounding 22%. So remember, when it comes to the Fed balance sheet, this is really the metric I think that matters. Or if you look at how much debt, how much gross, federal government debt, U.S. Treasury debt, does the Fed own as a share of GDP? And if you look at that, it historically ran at 4-ish%. Now that number is in the low 20s. These are the numbers that really matter. The balance sheet is still far too large. He did also mention a shift away from a specific inflation strategy that they had talked about, again, post 2008, this flexible inflation policy. We have eliminated the make up strategy for inflation, focusing instead on flexible inflation targeting. So the make up inflation, this was the post 2008 kind of regime. This was where, if their long term goal is 2%, and we have a year at 1%, that there is a makeup that they should be trying to make up that lost 1% spread. They are transitioning much more to a flexible inflation targeting regime. Clearly, things have changed. Clearly, the economy globally and domestic has changed since that kind of great moderation following 2008. He also made a comment on focusing on long-term stability. You can tell he is, worried about legacy, worried about long-term stability at the Fed. says that our framework emphasizes commitment to act forcefully to ensure long term inflation expectations remain well anchored, supported by balance sheet adjustments. So, again, not the most news that was coming out of this. I think really the takeaway here is that a lot of hawkishness had been priced in over the past couple days. We can see that in the S&P 500 and Mag 7 and Nasdaq sold off decently hard over the past week. Well, as he came in and said, basically revealed that he was not as hawkish as the market was expecting, these assets are rallying. But it is important to note gold and Bitcoin rallying as much as they are with the dollar selling off, this kind of dollar weakness theme that we have been talking about going back all the way to March or April, whenever we started the channel. This remains in effect for medium to long term. Really, there could be an argument that there's really no need for rate cuts. The problem with the economy today is that it is so different from everything that everyone knew before. We have the K-shaped economy where, the top 10% are doing half of consumer spending, which is 68% of GDP. We have this asset owner versus labor disparity in the distribution of income and wealth. We have all sorts of issues, immigration policy and the labor supply and suppressed real wages and all these various things. So, trying to kind of operate today as you did post 2008, post.com, is going to be difficult. There could be an argument made that the Fed should hold rates and should not be cutting rates. So this should be seen as mildly dovish. If I had to give a characterization of it, I would say that it was mildly dovish. Thankfully for the dollar, it was not moderately or significantly dovish because the dollar would be down even more. Bitcoin and gold would be up even more. And so risk assets are liking it. They remember risk assets like the S&P 500 and the Nasdaq like lower rates. Now remember, IWM is the most sensitive to interest rates. So IWM is actually making the biggest move. This is up 3.8%. This is the small and medium cap Russell 2000. This is what's making the biggest move. So, anyways, hopefully that covered all the major points. Remember, at the end of the day, the federal funds rate does not matter that much to you because what matters for your mortgage, your car loan, credit card interest rate, those sorts of things, those are priced off the 10 and the 30-year yield, which are basically independent from the Fed. So, what they do to the overnight dollar market, the overnight cost of a dollar loan, if they cut this 25 basis points, it's not going to make a material impact for your rates, your interest cost, which is affecting, say, your mortgage, your car, your credit card, those sorts of things. In fact, there can be an argument made that if they cut too much, as the market indicated here, right before the last election, rates actually moved higher. Right. So the Fed cut 50 basis points in September last year, and then another 25 basis point cuts. Well, the market didn't think those were needed. And so what did it do? The 30-year yield went up by 100 basis points. So if he is too dovish, if they cut rates too much, we are in a bear steepener. We are in a rate cutting cycle. And what have we seen? If we look at it as a rate cutting cycle, what have we seen? We've seen the 10 and the 30 go up. In fact, even the belly of the curve has gone up since the rate cuts started. So this is unlike anything we've ever really seen in the US. That is not generally how it goes. So if he is too dovish, there is a major risk that yields at the long end start to move sharply higher and the dollar could sell off. And again, that's generally kind of the opposite of what you expect. So there is risk that they are too dovish. But of course, the labor market is showing some weakness. NFP was quite weak. But they're really kind of between a rock and a hard place no matter what they do. I think he took a fairly middle of the road, although slightly mildly dovish approach today. And so we will continue to watch it, but hopefully that was a good overview of everything. I understand it's a lot, but hopefully that was educational, good overview, good summary. And I will catch you in the next one.